Hey, this is Nick Kristoff with the Kristoff team, and today I wanted to talk a little bit about cryptocurrency, Bitcoin, things like that, and particularly how they're involved in the loan process, or how they can be involved or not in some cases, and why that is. So we get a lot of questions lately about the use of Bitcoin or cryptocurrencies for a down payment, reserves for a loan, other assets that can be used in the transaction. And the question is, can I use them? How do I use them? All of that. And I want to talk through that. So in order to do that well, the first thing that comes to mind is, what is a lending institution trying to do with assets in the first place? What are their requirements for documentation, verification, etc.? And there are a number of factors that come to play, but the obvious ones, primarily for government-style loans, Fannie Mae, Freddie Mac, FHA, VA, etc., anything that kind of falls in that realm. And because of that, a lot of bank portfolios have adopted these guidelines. There are also some regulatory elements that are involved regarding the verification of the source of money. So one of the things that for many folks is a feature of Bitcoin is that it's not easily traced to a particular individual. But from a lending point of view, that means it's also not easily traced to an individual. So as part of the loan guidelines, lenders are required to verify things like, is it the borrower's own money? Did they get it as a gift? Is it a loan? Was it derived from an illegal source? Is there a party in the transaction? The seller, the loan officer, the realtor? Is there someone giving money that hasn't been fully documented? Is there something happening outside of a sales contract on a purchase transaction? So there are all of these factors in play that lenders are required to verify. And when you're talking about something like Bitcoin or cryptocurrency, there's really no way to verify that with any real ease. The documentation trail is usually not traced very much to an individual. And so in that case, the way, at least at the moment, at the time of this video, Fannie Mae, Freddie Mac, and many other lenders are handling it, they're handling it much like a personal asset. Some other asset that you own, a lawnmower, a watch, a something, right, that if you were to use it for the transaction, it would need to be sold or liquidated, converted into a US currency, deposited into a standard bank account, brokerage account, something like that, and then typically seasoned, which means it has to be there for typically a period of at least 60 days. In some cases, some lenders are going to allow you to do it a little bit less than that. If there is some mechanism to trace the funds, you have a Coinbase account or some other kind of account where the funds have been sitting, can document that it was your account with your name, etc. But otherwise, if it's really just funds have shown up from somewhere, they're treated as unsourced funds. Need to be seasoned, or then it can't necessarily be used. So those are the factors at play. There's a lot other things that we're probably going to be seeing coming from these big regulatory agencies, as well as the GSEs, Fannie Mae, Freddie Mac, in terms of how they plan to handle or create documentation requirements around cryptocurrency because they're becoming so popular. But for the time being, at least, those are the guidelines we're dealing with. If you've got cryptocurrency and want to use it in a transaction, you've got questions about how to use other kinds of personal assets for a purchase loan or refinance, something like that, feel free to reach out to the Kristoff team. We'll be happy to help. Thanks.